Today, let's talk about the Indian rupee.
So what is happening with the rupee?
Rupee falls, the Indian rupee
Plunged to an all-time low.
What if the rupee continues to fall? What if 100 rupees only buys what 80 rupees used to? Your fuel costs surge, imported goods get expensive, and even your foreign travel dreams take a hit. But why is this happening? More importantly, what happens next? Today, we break it all down. So why is the rupee falling? The rupee's fall to 87.99 is not a random event. It is the result of multiple forces pulling it down. Let's start with a global picture. When the US Federal Reserve hikes interest rates, global investors move their money to the US for better returns. This pushes up the value of the dollar and weakens emerging market currencies, including the rupee. In January and February this year, foreign investors pulled out 1.12 trillion rupees from the Indian markets. It's like a stadium where fans start leaving early. Suddenly, the energy drops. For the rupee, this outflow means less demand, leading to a weaker currency. India imports nearly 88% of its oil. If oil gets expensive, India has to spend more dollars, worsening the trade deficit and weakening the rupee further. India's trade deficit hit $37.8 billion in November 2024, nearly double the previous year. Imagine a family earning 50,000 rupees but spending 80,000 rupees every month. That gap must be filled somehow, and for India, that somehow is borrowing more dollars. Do you think India's trade deficit is the biggest threat to the rupee's stability, or are there deeper structural issues? To dive deeper, we asked this question to Pronab Sen. Sen is the former Principal Economic Advisor to the Planning Commission and ex-chairman of the National Statistical Commission. He was India's first chief statistician overseeing the National Statistical System and also served as Secretary, Ministry of Statistics and Program Implementation from 2007 to 2010.
We've practically always run a trade deficit. All right? And the rupee has not been very unstable. We have depreciated, but we have depreciated more or less, in a controlled way. So I don't think the trade deficit, and the trade deficit, in fact, today is not as high as it was earlier. It has been earlier. So that is certainly not the case. There are other issues, and to my mind, the bulk of the issues are not within the country. They stem essentially from what is happening in the global economy. Remember, the exchange rate is a relative price between the rupee and the dollar and other currencies. And so what's happening there will affect the stability of the rupee.
What happens when there are sudden shocks in a currency's value? A falling rupee is one thing, but sudden movements in a currency's value can create chaos. Why? Because unpredictability makes businesses and investors nervous. Imagine you're running a restaurant and every day the prices of vegetables fluctuate wildly. How do you plan your expenses then? That's what businesses face when the rupee suddenly weakens, investment slows down, and panic sets in. A weaker rupee means India pays more for essential imports like oil, technology, and machinery. That cost eventually hits you, the consumer, through higher petrol prices, costlier groceries, and increased travel expenses. This is where the Reserve Bank of India comes in. Its job is to prevent extreme fluctuations. But can the RBI always save the rupee? How effective is the RBI in controlling volatility? And is intervention always the best approach?
Volatility is never a good idea. Because what it does is that it creates a lot of uncertainty and to risks, both of which are bad for economic activity. So controlling the volatility is important. But to try and control the level of the rupee in a situation where it's happening because of events which are not within your control is usually a bad idea.
We put this question to Ajay Shah, a distinguished economist and researcher at XKDER Forum. Shah has previously held key positions at CMIE, IGIDR, the Department of Economic Affairs, and NIPFP.
On a day-to-day basis, the world changes, and the exchange rate is a shock absorber. Continuously, the exchange rate responds. If there's a war in Ukraine, the Indian rupee will depreciate. If there is a great boom in digitalization business from all over the world in the pandemic context, giving software development work to Indian software companies, the rupee will appreciate. Moment to moment, the rupee is adjusting. And it is a constant response to news. It's a constant response to developments. If you try to throttle the rupee movement, you lose the shock absorber. There is a law which is called the RBI Act, and the law has clearly given RBI an objective of delivering an inflation target. So RBI's job is to deliver 4% CPI annualized inflation. It's not to play with the exchange rate. So first, mandates matter. All the way till 2016, RBI did not have a mandate. So it was a confused law. In 1934, the British law had the following text in the preamble of the RBI Act. They said that RBI is a temporary measure. Given the present state of disorganization of the international monetary system, as a temporary measure, we create the RBI, which is fine. I mean, we were clueless at that time. We did not know what is monetary policy. So fine, all kinds of bad habits crept in, like trading on the exchange rate. But that changed. Now we're 2016. The law has been changed. The RBI has no objective on the exchange rate. The RBI has an objective on inflation. The first, when RBI does things on the rupee market, this is off mandate and it is not consistent with the law. Second, as I just argued, it's not wise for the RBI to manage the rupee. How is an RBI official to develop a point of view on what is the correct rupee dollar exchange rate? It's not possible. There is no book in this world. There is no research paper in this world that can teach you that 82 is okay and 87 is not, or 87 is okay and 97 is not. India is better off if the market makes the price of the rupee rather than an official. And every time the officials try to manage the rupee, it induces distortions upon the economy.
So who wins and who loses when the rupee falls? A weaker rupee isn't bad for everyone. In fact, some sectors celebrate when the rupee falls. Take exporters, for example. If you're selling software, textiles, or pharmaceuticals abroad, a weaker rupee makes your product cheaper in the global market. This boosts revenues for industries like IT and manufacturing. In the short term, the government. Since India earns in rupees but owes foreign loans in dollars, a weaker rupee temporarily helps with budget balancing. But what about importers? Well, businesses importing goods like electronics, chemicals, and machinery suffer as costs rise. And what about students and travelers? Well, if you're studying abroad, a weaker rupee means you pay more tuition. Planning a foreign trip, your expenses just shot up. Should India allow a controlled depreciation to boost exports? Or will the long-term negatives outweigh the positives?
As an economist in India, do I become happy when there is a rupee depreciation? The answer is yes. Why? Okay, so three things happen. Step one, foreign goods become costlier in India, and Indian companies competing with foreign goods, they get a more effective competitive position, which is good for Indian companies. Okay, please note, I'm absolutely not for any kind of protectionism. I'm not proposing customs duties, etc. This is just market dynamics, that if the rupee depreciates, then Indian cloth becomes more competitive against foreign cloth, and that's good for Indian companies. Step two, when the rupee depreciates, Indian exports become more competitive in world markets. So if you take an Indian product costing 1,000 rupees and you divide by 100 rupees to the dollar, then it's a $10 part abroad. If you divide by 50 rupees to the dollar, it's a $20 part abroad. So the same part costing 1,000 rupees in India gets a bigger revenue from overseas sales, gets a bigger market share in the world market when the rupee is more depreciated as compared with a stronger rupee. So this again is good for India because more business comes to Indian export companies. Third, there are many goods which are priced in the world market. The technical term is import parity pricing. Okay, so there is no Indian market of steel anymore. There is only a London Metals Exchange price of steel. The Indian price of steel is the LME price of steel multiplied by the exchange rate. So when the exchange rate depreciates, the revenues of Indian producers of steel goes up, their profitability goes up, they are more likely to invest. So that is the cause of Indian growth. When times are bad in India, there is pressure on the rupee to depreciate, and that is an equilibrating response.
Now the big question, should the RBI keep defending the rupee or should it step back and let it float? But what is a free-floating currency? Think of a boat on the sea. In a free-floating system, the rupee moves based on market forces like waves in the ocean. If demand is high, it strengthens. If low, it weakens. And what is a pegged currency? Now imagine tying that boat to a dock. That's a pegged currency. The central bank fixes its value to another currency like the US dollar to prevent volatility. India's middle path has been a managed float. India uses a managed float system where the RBI steps in when needed but doesn't completely fix the rupee's value. Should the RBI continue spending its reserves to defend the rupee? Or is it time to let market forces take over?
There is a difference, which is as you brought out in the previous question previous to this, about the RBI intervening in the market to contain volatility and the RBI intervening in the market to prop up the rupee at a particular level relative to the dollar. So the first objective, which is that of volatility, is perfectly justified and should be done. The second objective is a much bigger question mark. And everything depends on how you're reading it. If it is the way I read it, which is it is not that the rupee is weakening, it is that the dollar is strengthening, then for us to deliberately strengthen the rupee would usually be a bad idea.
What next for the rupee? Could the rupee hit the 90 mark? Maybe even 95? Analysts are divided. The future of the rupee depends on three major factors. US interest rates, for example. If the Federal Reserve keeps hiking rates, the rupee could weaken further. Or oil prices. If crude oil stays above $100, India's trade deficit will continue to grow. And lastly, government policies. Tax cuts, trade policies, and RBI actions will shape the rupee's fate. US trade policies. The imposition of reciprocal tariffs on Indian goods starting April 2 could affect trade flows and impact the rupee. RBI's actions. Offshore forward contracts maturing in April may also influence the rupee's movement. How much further do you see the rupee falling and what policy measures could help stabilize it?
Well, that is difficult to say. What is happening is that uncertainties in the United States are going up very quickly, economic uncertainties. And therefore, we may well see a situation where the dollar starts weakening. So the dollar actually gained from this uncertainty in the initial periods when there was what's called a flight to safety. That is, people whose basic currency in which they transact is the dollar, they were basically running back to the dollar because once you've got dollars, that value isn't changing. But if the US economy looks rocky, then they're going to start worrying. So again, I think much depends on what happens there. And my personal view is that the strength of the dollar is not going to last for very long, unless something very dramatic happens in the US, which I don't foresee.
So is a weaker rupee good or bad? The rupee's fate is tied to India's economic future. While interventions can slow the fall, deeper issues like trade deficits and over-reliance on imports must be addressed. So is the weaker rupee good or bad? It depends on who you ask.
So I do not think that volatility of the rupee is a problem. I do not think that volatility of the rupee is a bad thing. In fact, it is a good thing. Okay, so we in India have understood that when the government keeps the price of petrol fixed, it's a bad thing. You get into trouble. It is better to have prices that fluctuate. Then supply and demand will clear. They'll figure out what to do. Okay, so similarly, if you keep the price of wheat fixed, then it's a problem. So in fact, I don't share the premise that rupee volatility is a bad thing. Rupee volatility is a good thing. Similarly, I don't share the premise that rupee depreciation or rupee appreciation are a reflection upon the goodness or badness of the country. It's not a correct way to think about it. Okay, so if you think of a great country like Japan, their exchange rate is like 140 Japanese yen to the dollar. It's just a unit. It's a exchange rate. It is not a comment on the country. You want to measure the prosperity in India, you should count per capita GDP. Okay, you should count childhood stunting in India. That is the way to think. Is India doing well? Is India doing badly? There is nothing wrong in having a rupee at 160 rupees to the dollar. There is nothing wrong in having rupee volatility.
What do you think? Should India defend the rupee or let it fall to boost exports? Comment below and join the discussion.